Good morning. Welcome to this update from Phoenix Blue on Wednesday the 7th of September. I'm Tom Colley and I'll talk to you about the markets from yesterday and look forward to opportunities that we may have in the market today. Yesterday, big event in the sense that we had some really poor data out of the US on their services. We'll have a look at that in detail in a moment, but it led to a big move in the US dollar and gave us the opportunity to be grateful for our stop losses. Okay, well, let's have a look at the news in the first instance. Yesterday morning we had a rate statement from the Reserve Bank of Australia. They held their rate at 1.5% as expected. I believe they are hoping that the Fed, the US Central Bank, will raise their rates and do the job for them in tempering the current strength in the Australian dollar. However, they may have quite quickly by yesterday afternoon have been quite disappointed to see this number. This is the number that caused the really big movement on US dollar yesterday. This is the ISM non-manufacturing PMI. It's effectively the services part of the economy. We had been looking at a forecast of 55.4 following a previous month figure of 55.5. We actually got a number of 51.4. Now, to put that into context, that was the biggest miss, the difference between the forecast and the actual for 5 years, and the lowest actual figure for 6 years. So a really, really big underperformance. Of the 18 industries that this survey covers, 7 industries actually contracted last month, compared with only 3 the month before. So can't really emphasize how significant that was, and that was reflected on the charts yesterday with a really big weakening in the US dollar. But we'll go on to have a look at that in detail in a moment. We also had a speech from the Swiss National Bank Chairman Jordan. It was at a conference. The speech was exclusively related to the conference and didn't actually have any comments whatsoever relating to the general Swiss economy. Overnight, we've had some slightly negative numbers on gross domestic product from Australia, and look, this morning we have manufacturing production figures on the pound. Will be an interesting watch because, again, more data that is post-Brexit vote. And then we have the inflation report hearings at 2:15 when the Bank of England will be in front of the Select Committee in Parliament. This afternoon we have a Bank of Canada rate statement. Anticipation here, as per the forecast, is no change in rate there. There's been some more positive data recently. The effects of the recent oil sands fire and things like that are beginning to wash out. So in actual fact, what we're probably going to see is what the central bank talked about in their last statement, and the economy seems to be following the pattern that it suggested. So we see no reason there why we'd see any sort of variation in that rate. Overnight, also, before we have another morning update, we have the Aussie trade balance, and then looking forward to tomorrow, we do have the ECB rate statement and press conference. But let's have a look at those charts now, and let's see what that really negative US services data actually resulted in. Well, this is the dollar index, and this is the big move down. This low test pin bar here, that's Friday. That was when the non-farm payroll data came in. It came in below forecast in all 3 elements. Price, the dollar devalued, but then buyers came back into the market and we ended with a close above the open. We also ended up with a weekly close, a bullish weekly close. So we were actually watching this market, and we were in our trading plans for the week, we were anticipating further dollar strength, or we were looking for that to play out in order for the opportunities that we'd identified to come to fruition. What we saw obviously is this big move down. Those numbers were so poor, but then on the back of the optimism that there had been here, they'd taken the below par numbers at non-farm payroll quite positively, but then adding to that some poor data. We'd also had poor manufacturing data on Tuesday of last week, so the net result is very, very negative for the US dollar, and potentially means or the likelihood of a September rate rise is now significantly reduced. We're coming into the period pre the US presidential election, so if we don't see a rate rise in September, we could be looking at the potential for the end of the year again in December, like we did last time. Which, if you think back to last December, if you were trading the markets at that time, the December rate hike led people to believe we might see between 4 and 6 rate rises in 2016. But as we know, that just hasn't played out. The US economy just hasn't been as strong as anticipated, and the Fed haven't been willing to raise rates without the data being more consistent and strong. But we'll obviously see how that plays out through the Fed rate decision later in the month. Over on the yen, well, as you'd anticipate, a big pullback. The Bank of Japan would not have been happy about these numbers and what it did to the dollar strength and the strengthening of the yen here. We're coming back down to towards the 100 level, or even the 99 level, where we believe we saw intervention from the Bank of Japan post the Brexit vote figures coming out of the UK. We will be looking for intervention around the 100 level down to 99, and looking to take opportunities to the long side based on that intervention. I believe it's the 21st of September we have the Bank of Japan central bank rate announcement. They are also undertaking a survey of the effects of their current stimulus, in order to review that and potentially lead to decisions on what happens going forward. Okay, over on the euro, as expected, we see a bullish move on the euro as the dollar weakens quite dramatically. This level here, we had a trade in there that came straight through and stopped us out. Yesterday was one of those days you can't trade on the assumption that big one-off moves like that will happen. That's why we have stop losses. We're comfortable with the risk we put on the table. When our stop loss hits, then quite simply we lose the money that we're comfortable to risk. So we had a loss there. We're also short the Aussie, and lovely technical level through here. But the strength of that move on the dollar pushed us through. At this moment in time, we're still in this trade. We had some slightly negative GDP numbers, as I mentioned a moment ago, on the Aussie overnight, which potentially helped keep us in the trade. But I would still be surprised if that trade actually plays out into profit. But we do, just because that's our opinion, we don't change the trade. The trades that we place have all been thoroughly back tested. They have a probability. That probability needs to play out. In this scenario, it might be 1 in 10 that turns into profit, but that's part of the calculations that we've done, so we'll let it play out. If it hits our stop loss, no problem. Again, we have only risked an amount that we are comfortable with at any one time. Now, so where are we going to look for opportunity in potentially the opposite direction than we entered the week and we were planning if we'd seen dollar strength play out as we had predicted? Well, here's the pound. This level here at 133.50 is a significant level. We can see good support there. And again here, this is Monday, although it was a US bank holiday, so we were careful with what the results or what that actually meant. We had some very, very positive services data out of the UK, but we still, although we got a bullish movement, the market closed round about where it opened. So clearly there was still a lot of a lot of sellers in the market here at this moment in time. Yesterday's move on the dollar cleanly broke that. We've got to close above that level. It was a significant level of resistance. It's now a significant level of support, so we will be looking for price to pull back down there to take this trade, but only through to this next level here. Again, this is a significant level, but if you look back on your charts, on your weeklies and your monthlies, that level there is in fact the 2008 lows, which were previously the well, not the all-time, but certainly the all-time you'll see on your screens, the lowest point previously for 25 years or whatever. And then at this level above here, these are the 2009 lows. These dates being those that immediately followed the credit crunch in 2002-7-8, so very significant levels. So if we get the opportunity, we'll be taking a trade from 1335, looking to get half our money off the table in quite quick time, 50 pips or whatever, and only with a T2 target at this level here. If we do get a break and a retest, we will of course look to trade to the next level, but we're still cautious this market because our overall view, or our longer term view, is still bearish on that market. Another market that we're showing interest in now that we've seen that dollar weakness is the Swissy. Why? Well, the Swissy is seasonally the strongest currency pair in September. Now, I think I may have mentioned it earlier in the week, if this was a strong pair and we'd seen dollar strength, it's a currency pair we would have avoided, because we wouldn't want to be trading strength against strength. So it was a market that would have in principle not been of a great interest to us. However, now we've seen a weakness in the dollar. The dollar, interestingly, is seasonally weak in September. So we now have a scenario of the seasonality of both pairs playing out. So we are now interested in the short side of this. We'll be looking for a definitive close below today, and then going into tomorrow we'll be looking for a pullback to retest this 9.7 level here. Okay, another area that we've been looking at, and I think I've spoken about before, is gold versus the stock markets, the risk on, risk off scenario. Remember, we say we expect a risk on scenario when money is going into the risk asset, which in this instance is equities or stocks, and we would see price rising in the stock markets. We expect to see the safe havens, of which gold is the sort of fundamental one. We'd expect to see price move in the opposite direction as the money came out of the low risk asset into the higher risk asset, and we'd expect to see vice versa. But what we've seen through this period is a very confined trading range for the major US stock markets. I believe that's the longest period for 15 years that price has been as contained as that over that period of time. And in normal events, I would not be looking to trade gold or silver without having a risk on, risk off scenario. However, if we look at gold, this is a monthly trend line, long-term trend line. We've got a level here. If I see a break above these two levels here, I'll be looking for a pullback to take that trade long. I think it's the stock market that is not reacting to news in the normal way that we would expect. We saw yesterday very poor numbers on the services data out of the US. We would have expected to see this move in gold. Conversely, we should have seen, we would have normally expect to see a bearish movement on the stock exchanges. But what we actually saw is, if you could look at your NASDAQ charts, we actually saw a record high close yesterday. So we're not going to see, or until we see them fall into line, we haven't got a risk on or a risk off scenario. But I am, with a break of that level, if we get that, then I will be looking to take a bullish gold, a trade on gold. That has been our expectation for the whole year. Again, it hasn't played out. And recently we've had this disconnect on the risk on, risk off. Okay, guys, so we had a day yesterday to be grateful for our stop losses, but as with trading, another day presents different alternatives, and we've looked at 3 there on the pound, the Swissy, and on gold to take us forward into the rest of the week. Hopefully we're exhibiting flexibility and reacting to events whilst maintaining our understanding, our analysis and our rules. If you like the way that we trade, we have the opportunity for 4 hours of free trading with Phoenix Blue Fund Managers on Friday, September the 23rd in London. If you're interested in coming along to that, I said there's absolutely no cost. You trade alongside if the markets give us opportunities. We'll also tell you a lot more about how we trade, how we analyse, a bit about the commitment of traders and analysis we do. And you'll have the opportunity to speak to other Phoenix Blue clients who have whose results have improved dramatically having come on board with us. Keep your eye on Instagram Phoenix Blue Trading for that. If you are interested in this event, just pop onto the events page, which this is the same. Click through there and we'll send you an invitation and all the details you need for that event. If you have any other questions, email us at info@phoenixblue.co.uk, or you can get me at tom@phoenixblue.co.uk if you've got any specific questions about this video. Okay, have a great day's trading and we'll speak to you again in the morning. Take care.